Hey there guys, welcome back to another video. So if you're new here, I'm Jake and I make these simple investing videos. So in this one, I'm going to be showing how you can create your DIY ETF. So here's the DIY ETF allocation blueprint, optimized for balance growth plus 12,000 in dividends across 12 to 15 different stocks. So layer one is income anchors, target 45% of portfolio. These generate the yield base, the key insight shift away from Telus as my primary income engine and toward names with better total return profiles. So Enbridge at 10 to 12%, it's a 5% yield plus 3% dividend growth, 31 straight years of raises, strong free cash flow. Telus at 15%, trimmed down from 34%. Yield is 10%, is excellent income, but payout ratio is 294% of earnings per share, which is a structural risk. Keep it, but don't let it dominate. Royal Bank at 8 to 10% with a 2.5% yield plus 7% dividend growth. The total return here is 62% over 1 year. It's not just income, it's price appreciation with the dividend on top. TD at 5%, 2.8% yield. Q2 earnings per share is up 21%, recovering from its U.S. regulatory overhang. Bank of Nova Scotia 3 to 4%, 4.1% yield, and a 3.6% raise this quarter. Layer 2 is compounders, target 40% of this portfolio into these. So these handle the return mandate and keep pace with / beat the S&P 500. Microsoft at 18 to 20%, hold the position, 19.9% yield, but 10% dividend CAGR, compound annual growth rate, plus the price appreciation thesis, analysis consensus 629 price target versus 388 today, meaning upside. It's a meaningful upside. So TRY at 15%, 3.1% yield plus AI data analysis tailwind. This one actually does double duty, decent income and compounder profile. Avgo 7 to 8%, low dividend yield now, 0.67%, but 10-year dividend CAGR of 26%. Total return beats once the custom ASIC thesis plays out. Layer 3 is swing / alpha target, 10 to 12% of portfolio. Nvidia plus AMD at 5 to 6% combined. Pure total return plays with no dividend contribution. Nvidia does have a dividend, but it's very small. So ENS at 3 to 4%. eSplit Corp contributes income, but with split corp structure risk. Why this blueprint works for the dual mandate. The key structural change is reducing T from 34% to 15% and redeploying into Enbridge and Royal Bank. You give up roughly 5% of raw yield on that chunk, 10% to 5%, but you gain a much safer dividend. E and B payout ratio is healthy. Royal Bank's 9-year CAGR beats T's cold, plus price appreciation potential that T simply doesn't have right now. So Telus is effectively a yield trap at current levels. 10% yield sounds great until you realize the stock needs to recover from a 50% drawback just to break even on total return. One important note, though, is this is your RRSP. Since all income is sheltered, the tax-free compounding of dividends actually makes the higher yielding names more valuable than they'd be in a taxable account. The reinvestment power is amplified. Telus' 10-year 10% yield, compounding tax-free, is genuinely powerful. It just needs the price to stabilize, which is the question mark. Bottom line, on 12,000 income timeline, a 150,000 portfolio on track. 5.5% blended yield equals 8250 a year, getting closer. So a 200,000 portfolio at 5% yield is 10,000 annually. So a $300,000 portfolio, 4.5% blended yield is 1350 a year. So target achieved with the room to spare, and the growth stocks pulling their weight on total return. The 12,000 target is achievable by end of 2027. If I hit the capital deployment plan and rebalance the layer 1 mix as outlined, the portfolio doesn't need to sacrifice total return to get there. It just needs to swap Telus concentration for diversified Canadian income names with better price upside. So that's how you build a custom DIY ETF that will beat the S&P 500. So if you scroll back up and look at the stocks here, so 10% into Enbridge, 15% into Telus, 10% Royal Bank, 5% TD, 3 to 4% Bank of Nova Scotia, 18 to 20% in Microsoft, 15% in Thomson Reuters, 7 to 8% in Avgo, 5 to 6% in Nvidia and AMD, and 3 to 4% in ENS. So if you got any value out of the video, like and comment and subscribe to the channel, and I'll be back for more investing videos.